Okay, let's take a look at this little example that illustrates the accrual accounting concept that income is recognized when it's earned. Okay, so here's the situation, and I'll just read it to you. Class, let's say Wilson University has a football team and it plays 9 home games. It sells advanced season tickets for $400 per ticket, and this year it sold 10,000 tickets. Let's assume Wilson's fiscal year ends after 5 home games have been played. Where would we find the cost of the tickets on Wilson's financial statements? Alright, now I've worked this ahead of time. So the tickets sold were 10,000 and the price per ticket was $400. So if we want to think of this in terms of sales, the total sales would be the 4 million times 10,000. But probably I should label that correctly. That would be total season tickets, and what do we want to call it? So it's a total season ticket revenue. Probably want to call it that because sales really deal with selling a tangible product. We tend to use the word revenue for services. Okay? Let me put this. We'll move on here. Alright, so the games played to date were 5. This is by the end of the fiscal year. Total home games were 9. So we could reasonably assume that we should record about 55.6% of the revenue, and you could use 56%, but I'll use the actual percentage and just show it as rounded to 1 decimal place. So the football ticket revenue that would be earned at the end of the fiscal year would be the 4 million times the percentage completed, the 55.6%. And that comes out to be $2,222,222. That's the amount of revenue we would see on the income statement of Wilson University. We'll assume Wilson University is a for-profit entity. Okay? And on their income statement, it will show football ticket revenue or ticket revenue. We're not sure what it's really called. But the point is $2,222,222 would appear on the income statement. And the balance, which would be equal to the $4 million of total season ticket revenue, less what we recognized, would remain on the balance sheet as unearned revenue. Now, it might be called unearned ticket revenue. It might be called season tickets paid in advance. But it essentially is an unearned revenue account, which is a liability. It represents our obligation to our customers, if you will, the season ticket holders, that we owe them that amount of value that we still haven't completed. Now, once the season ends, we could adjust for that and then record that remaining $1,777,778. Now, one other thing I want to point out is, at the time the tickets are sold, we would show the cash increasing on the company's balance sheet. Now, by the end of the season, the end of the fiscal year, that cash will probably be used for a lot of other purposes, so there'll be other transactions that impact it. But the point here is that Wilson University will collect $4 million in cash, so cash will be increased. When it gets to $4 million, and I wrote it over here, it will likely increase cash and then also increase an account called unearned revenue season tickets, or maybe it's just called unearned revenue, by $4 million. Now, the company, the company meaning the university, may also record it as revenue up front. They may show it as ticket revenue. But if they do that, then they have to make an adjustment by the time they issue the financial statements, so that only $2,222,222 show up in revenue, and the rest remains in unearned revenue. So in other words, whether they increase unearned revenue season tickets by $4 million as they collect the cash, or whether they use a ticket revenue account, an actual income statement account, an adjustment needs to be made before the fiscal year ends and before the financial statements are issued, so that it correctly shows the amount of ticket revenue that was earned and that correctly shows the amount of unearned revenue that will appear on the balance sheet. Okay, I hope that was helpful.